Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by Zacks Director of ETF Research, Neena Mishra, to talk about how you can buy gold right now here in 2025. And why are we bringing up gold? Because it's reaching new record highs once again. It did last year in 2024, and then it pulled back a bit and everyone forgot about it. And now it's back on the scene, surging up again, here to start the new year. And it's eyeing that 3,000 level, which is kind of the key psychological investor level. And what happens then? Will it keep running or not? I asked Neena to join us this week because she's been following the gold story as well on the ETF side. And there's many ways you can buy gold. You can, of course, buy it in jewelry. You can get it in coins. You can go to Costco and try to find the gold bars that they were selling. But from what I hear, those are sold out. But maybe they got some more back in, but you can buy it at Costco, or you can use stocks, ETFs, and those means to get it. So I like using ETFs to buy gold because ever since they launched the original physical gold ETF, that's been an easy way to actually own it without having to buy some gold bars and hide it in my closet. So that's why I asked Neena to come on, because this is her area about what's happening with gold. Now, you would think with it being this red hot that maybe we would see a lot of money flowing into the gold sector, into these ETFs. But I'm not so sure that's happening. And maybe that's a good sign for gold that this rally still might have some legs. So welcome to the podcast, Neena.
Hi, Tracey. Thanks for having me on. So gold has really been surprising. It has done so well last year, as well as it continues to do well this year too. Last year, gold was up about 26%, but Bitcoin and Bitcoin ETFs launched last year. Bitcoin more than doubled last year. So maybe a lot of investors, particularly younger investors, they pivoted to those gold ETFs. They pivoted to Bitcoin ETFs. So gold ETFs did not see a lot of inflows last year in 2024, despite excellent performance. Inflows were really, really tepid. And this year also, so surprising, gold is up about 11% year to date. But US investors have not been buying gold ETFs. On the other hand, gold ETFs, which are listed in Europe and in Asia, they have seen a lot of inflows, particularly in Europe. Maybe European investors got tired of lackluster stock performance in Europe. They don't want to invest in their own stocks, and maybe they are more worried about these trade wars and tariffs and all that. So they have been buying gold ETFs, and gold prices in particular, they have been boosted by central banks' purchases. So central banks have been buying a lot of gold last year in particular. Gold demand touched a new record high. And we have seen this trend for the last 15 years or so. Central banks have been buying a lot of gold, and that gold buying picked up particularly after the war in Ukraine. And maybe now central banks around the world, they are also a little bit concerned about the debt situation, the fiscal debt situation in the US. So they don't want to invest so much in US Treasury bonds. So they want to diversify out of the US dollar and US Treasuries, and they have been investing in gold. They have been buying a lot of gold. And that is one of the main reasons why gold has done so well last year and this year as well. And flows into gold ETFs, they have really been surprising. So January was another record month for ETF flows. And ETF flows, ETFs, US listed ETFs, they gathered about 96 billion inflows last month in January. And a lot of that went into US equity ETFs. Investors continue to buy technologies ETFs, particularly those which dipped last month. So they were buying a lot of tech ETFs on dips. They were buying leverage ETFs. They were buying option income ETFs. They were buying a lot of financial ETFs too, because financials have been doing well. But no, not a lot of love for gold ETFs. Bitcoin ETFs again saw some decent inflows last month as well.
Now, what is the comparison with what's happening this year? So I'm not surprised that a lot of money is flowing into those Bitcoin ETFs. That makes it very easy, like the original gold ETF did about 20 years ago, to get into the Bitcoin thing now. But it seems just strange to me where literally almost every day we're getting these new highs on gold and no one is paying attention. But it also seems strange to me that even the professional investors don't seem all that interested in what's going on with gold.
Right. So we have seen some decent flows into bond ETFs as well in 2024 and in January again. And particularly ultra short bond ETFs, they have done quite well because, rates have stayed high, shorter term rates have stayed at high levels. So if you can buy a short term, ultra short term treasury bond ETF or a money market like ETF and get that 4.5% income, advisors and many investors like that, they are not looking at gold. And younger investors, they continue to buy those Bitcoin ETFs and for Bitcoin ETFs, there was a lot of pent up demand too, because investors waited for almost 10 years. Bitcoin ETF filings were initiated more than 10 years back by the Winklevoss twins, and then SEC continued to reject. So that is one of the reasons there was so much pent up demand for Bitcoin ETFs. But lack of interest in gold ETFs, it really surprises me that investors, advisors, they are not adding gold ETFs to their portfolios, to their client portfolios for diversification. And in fact, I saw an interesting article in the Financial Times recently. Let me share my screen and show this. So this analyzed the performance of gold as a diversifier in the portfolio or as a hedge in the portfolio over the past 20 years or so. And this shows that gold performed much better than other diversifying hedges like bonds over the past 20 years. So if you look at the performance during the financial crisis and then in 2018 and in 2022, when stocks had a terrible performance, gold did quite well, particularly during the financial crisis. Gold was up 21%. Now in 2022, when both the S&P 500 index and bonds fell, gold fell much less. So gold has done quite well as a hedge in the portfolio. And I usually recommend to investors that they should have about 3 to 5% gold in the portfolio, just because of its diversifying properties. It makes sense. And particularly now, because there's a lot of uncertainty about tariffs, about trade wars, it makes sense to add a little bit of gold to your portfolios, and particularly when stocks are going to continue to be so volatile. Maybe adding a little bit of gold makes a lot of sense. And gold ETFs, I believe, are the best way of gaining exposure to gold. Some of them are so cheap, you can buy a gold ETF for an expense ratio of 9 or 10 basis points, and you don't have to deal with the custody issues, or you don't have to put it in a locker or under your mattress and then worry about theft and all that. So, and they track gold prices perfectly. I know there have been some conspiracy theories that these gold ETFs do not own gold; it's just paper portfolios. But no, they actually own all that physical gold in vaults in London and in Switzerland, and they have posted pictures of the vaults. So they actually own a lot of gold, and they track gold prices very, very closely.
Okay, so that was my next question then. If I do want to use ETFs as a way to buy the gold, do I want the physical gold ETFs or do I want to buy the gold miner ETFs? Do you have a preference?
So it depends upon your risk tolerance. So if you want a lower risk exposure to gold, then maybe an ultra cheap gold ETF makes a lot of sense. And let me share my screen again. So GLD is the most popular gold ETF, and it is used a lot by traders. It is also the oldest one, but this has an expense ratio of 40 basis points. And after that, State Street launched a cheaper version of gold ETF. It is GLDM, the Spider Share Gold Mini Trust ETF, and this charges an expense ratio of just 10 basis points, so ultra cheap. And there's one which is even cheaper, which is by iShares, IAUM. So it is called the iShares Gold Mini Trust ETF, and this charges an expense ratio of just 9 basis points. Now, there's not a lot of difference between 9 and 10 basis points. So both GLDM and IAUM are suitable for long-term focused investors. You can look at either of them. And GLD, if you're a shorter term investor, and if you care about liquidity or you want to trade in and out, then look at GLD. Now, if you want to look at miners, so miners act as leverage play on gold. So obviously they will do quite well when gold prices are going up, and GDX is the most popular gold miner ETF. It is by Ryniec. You see that year-to-date returns 24%. Oh, wow, that's
Look at that
huge.
Expense ratio, though, on it.
Yeah, it is expensive.
Pretty high.
So you can get
0.51 for those who are listening.
Yes. So these are much more expensive. Whereas you can get exposure to gold at just 9 or 10 basis points. And if you want to look at smaller companies, then maybe look at GDXJ, which has also done quite well. And this holds smaller gold miners, and I'm pretty sure the expense ratio, it is the same, 52
it's
basis points.
Same,
51 and 52 basis points.
Now, I did notice I used to own both of these in my own portfolio, but like 15 years ago, when gold was last kind of popular and hot, I did want to own the miners. But there has, it seems, been a lot of consolidation in the industry, because when I took a look at the list on the juniors, especially of the junior gold miners, just to see, I used to know like a lot of the company names, and I own some of them as individual stocks. I did notice that on the top 10 list for the junior gold miners, that those 10 holdings are 41% of the entire portfolio, but there's 2 big silver miners that are included in there. And that's because even in years past, they had a hard time finding enough publicly traded miners to even be in the junior one. And now it's got to be even worse. And maybe that's why, the silver one is 6.3% of the gold miners junior ETF now. The Pan American Silver is that company. And then Hecla's on there too. But that's just something to be aware of. And usually a lot of times gold and silver move in tandem, and you do mine more than one type of metal. Usually they will usually have like a small production in silver at a lot of the big gold miners. And then the silver guys sometimes have a small production in gold too. So there's, you're in both areas usually anyways, but it's something to keep in mind that you may get some silver in there too. And there's really not much they can do about it because they're just desperate for any kind of publicly traded, like, something that has some gold to put in there. But I still do like the junior miners. Like I like the juniors to some extent in like oil production and exploration as well, because they are just a little bit, I don't know. They're able to explore a little bit easier. But with gold mining, people should always keep in mind it is global, and a lot of geopolitics can come into play depending on what's going on inside those countries, wars, weather events. There's all this stuff that goes on, and it can really influence what happens with production with a lot of these companies. I know I owned a big gold miner in the Value Investor last year, and they had some real production issues go on towards the end of the year. That was just on execution for themselves. And so they were having trouble getting the gold out of the ground. So it didn't really matter if gold was at 3,000 an ounce, because you got to get it out of the ground for any of these companies. And so that was a little frustrating, but buying an ETF kind of alleviates some of that risk because you're now owning all of these. If one of them is having troubles in one of their countries with the mine, or there's weather, they're all, hopefully not having the same thing. So, you're going to have some, less risk there if you own this basket of the miners, but it is still about getting it out of the ground. But even just looking at some of the numbers, and we're getting a lot of these gold mining companies reporting earnings here in February of 2025. And so it's worth it to check in and see what they're saying about the average gold price that they expect now. I'm seeing a lot of the analysts are looking for $2,500 an ounce for 2025, but they are also modeling for the idea that it might hold at 2,800 for the full year. And, even just that $300 an ounce difference is, hundreds of millions of dollars in free cash flow for all these companies. So that's another thing that I do think could be interesting with the miners versus owning the physical metal ETFs, is that eventually they have to do something with that free cash flow. And it usually means, special dividends, or they initiate a dividend, or they do a share buyback, or a combination of all those things. So if that floats your boat, in addition to what the actual underlying metal price is doing, then the miners are kind of an interesting play right here.
Right. And you're very right about, getting exposure to other issues. You are not only getting exposure to gold prices, you are getting exposure to other issues also. There may be strikes, there may be other political issues, there may be power issues in those countries. So yes, having an ETF which has a diversified basket of these miners, that makes a lot of sense. And since you mentioned the holdings, let's show the top holdings in these two ETFs. So if you buy GDX, you are getting a lot of exposure to Newmont, which is about 12.3% of the portfolio. And then Agnico Eagle Miners, that's also about 12%. And then there are other ETFs, other gold miners like Wheaton, Barrick Gold, Franco-Nevada, etc. If you are buying the junior one, so the top holding is Alamo's Gold, and the second one is Harmony, but the third one is a silver, gold, and silver
Right.
miner, which you were talking about, and then Evolution Mining. So this is what you are getting exposure to. But as Tracey mentioned, having a diversified exposure makes a lot of sense. If you look at the countries, these have a lot of international exposure. So let's first take a look at the GDX and geographical exposure. So you get about 47% exposure to Canadian companies, and then South Africa, Australia, Brazil, China, United Kingdom, all those countries. So there may be issues in South Africa, which you are getting exposure to, or Australia or Brazil. Let's take a look at the junior minor CTF, and the geographical exposure is somewhat similar, more than 50% to Canada, and then Australia, South Africa, and then US. So there are talks about tariffs on Canada as well, which have been postponed for a bit, but we'll see how those talks affect these miners and miners
Yeah. I
CTFs.
wonder if our jewelry prices might go up because of tariffs on Mexico and Canada.
Yeah.
I guess it's possible, right?
It's quite possible.
If they put it on gold, then, that's going to push all that up. I did see in the news that they were saying there was a rush on gold out of London. Apparently, people were buying it up ahead of the possibility of tariffs on the EU or on just Europe in general. And so they were trying to buy up some of these things ahead of time.
Yeah.
So that I don't know how much that's playing into it. Yeah, right. I didn't think I'd be talking about the tariffs and gold really, but it could be an issue. So yeah. Okay, so there are a lot of ways to play it. You can buy some of these individual gold miners as well. Like I said, I used to own one in the value investor last year, but I did get out of it on execution issues, really. And now I did just buy into B2 Gold, which is ticker BTG in the value investor portfolio. I bought back in, but that's a junior miner. And so I'm hoping, because the analysts believe that the junior miners are able to maybe up production here into 2025. So what I really want as an investor is not only, to capture that gold price that's rising, but if my producer, if I'm going to buy one of these miners, I want them to be producing more when the price is at these record highs, because that means more earnings, more free cash flow. So B2 Gold is expected, based on their production guidance, which they gave a couple of weeks ago in early February, that they are going to increase production maybe right around 26% here in 2025. And some of the other junior gold miners, it was similar. They are actually expected to see some rise in production, but not as much with the bigger producers for whatever reason, maybe because they're in the middle of, building out some mines. And so they're not producing yet at some of those, or these weather or political issues are going on some places and they're not able to get as much out, but a lot more of a flat production is expected for 2025. That doesn't mean earnings aren't going to go up. If we see the average price of gold rise, they are unhedged, so they will see benefits from the rising price as well, as long as, again, they're able to get it out of the ground and get it sold. So, but all of these look rather intriguing to me. And on top of it, they are all pretty cheap on a PE basis. especially as that earnings, if those start to rise as we head in, more towards the middle of the year with this higher gold price, then you'll see those earnings estimates start to rise too. But a lot of them have some good Zacks ranks. They're number ones and number twos, but we are getting earnings reports coming in right now towards the end of February here. So tune into those to see what the analysts are saying on some of these individual miner earnings reports. But I'm liking this whole trade. I'm still shocked that no one else is in it except you and I, Neena. We're the only one.
I added AUM ETF to the ETF investor portfolio that I manage, and I think gold will continue to do well this year.
Yeah. Okay, so let me recap the stock and ETF tickers we talked about. So Neena just mentioned the iShare Gold Trust. That's ticker IAU, M as in Mary. Then there is the GLD. That's the oldest physical gold ETF, ticker G as in George, L, D as in David. Then you can get the mini, which is cheaper to own. If you're a long-term holder, you do want to get as cheap as you can on those expense ratios. And that's ticker GLD, M as in Mary, GLDM. Then we did talk about the gold miner ETFs. There's the junior, the VanEck Junior Gold Miners, GDXJ. And then there's the bigger gold miners also by VanEck, and that is GDX. Then we mentioned a few individual stocks. I have the B2 Gold, and that's ticker B as in boy, T as in Tom, G. And then we did mention Newmont because they're the largest holding in that VanEck Gold Miners ETF, and that is NEM. And you definitely can check out the holdings for both of those ETFs. You get some good ideas about who's in the top 10. Oh, I guess I did mention Pan American Silver. If you want the silver miner, that's in the junior gold miners, and it's PAAS is the ticker on that one. So, a lot going on with gold. I feel like I'm going to be covering it some more. I covered it a couple months ago when I did a podcast on the top gold stocks to buy now. Those were mainly the big cap miners, but you might want to go check that one out on YouTube. You can find it there. You can get all of our podcasts on our regular YouTube channel. Just go to Zacks.com/YouTube. You can also get all of our other podcasts, including Neena's excellent ETF Spotlight, on our podcast channel. I know many of you are subscribing over there as well. It's totally separate. Those are just audio podcasts, but such great content over there. Check out ETF Spotlight and the Value Investor podcast over on our podcast channel. But be sure to get us somewhere, and I'll see you again next week with some more stocks.